Well, good evening, everyone. This is David True, and those of you who've been with us at NYPAY events before will know me. Those of you who have not, I'm the president of NYPAY, and we've been doing events on fascinating topics such as this one for many, many years now. This is probably getting on our 70th event. I want to thank you for joining tonight. We got a great panel and a great topic. Property technology. I mean, property's in the news a lot. We're hearing all the things going on there. And just as technology has accelerated change or affecting things in many other parts of the economy, it's doing the same in PropTech. And so we've got an event on why investors, corporations, startups are bullish on this new tech. And as always with these events, they only happen with the joint support of multiple parties. So I wanted to thank very much to Valley Bank and to Kesnay for helping to put this together tonight. And with that, I'd like to turn it over to Jennifer Byrne of Kesnay.
Thanks, David. Hi, everyone. Thanks for joining. I'm Jennifer Byrne. I'm the CEO and co-founder of Kesnay. And first, thank you very much to the NYPAY team, David, Nikki, Bill, for putting this together, and to our panelists for dedicating the time. And, also, I really want to thank Bob Bardish and Farina, Bianca, and Kurt for all the support from Valley Bank, who's the sponsor. Just quick background, Kesnay has been running Female Founders in FinTech, an accelerator program, and also producing events like this. And I just want to say that Valley Bank's been a terrific supporter of driving diversity and supporting our Female Founder program. So thank you. And I'm very much looking forward to the session today. I think it'll be very illuminating. And with that, I'll turn it over to Bob Bardish, the Chief Operating Officer of Valley Bank, who will be moderating the session today.
Thanks, Jen. Really great to be here. We really appreciate participating in this and getting the opportunity. Been a great relationship so far. As Jennifer said, I'm the Bob Bardish. I'm the Chief Operating Officer for Valley Bank. We're a mid-sized regional bank in New York, New Jersey, Florida, Alabama. We also have some offices venturing out into Chicago, Austin, Philly area. So they certainly spend a lot of time on the East Coast, and we have a big focus in commercial real estate and property management, small and medium-sized businesses. So it's really an important focus for us, especially around innovation and fintech and PropTech and cretech, all really important. So with that, I want to make sure that we get to introducing our esteemed panelists, and then we can get into some of the discussion. So Gloria, why don't you start us off?
Sure. Hi, I'm Gloria Fu. I'm an independent board member on PropTech Investment Corp. 2, which is a blank check company charged with looking for an acquisition in the PropTech space. My SPAC founders already did a D-SPAC, and it was called Porch, and it's publicly traded at this point. Prior to my board service, I was an institutional investor at JP Morgan for 15 years. I covered real estate, consumer, healthcare. So I'm kind of one of the old economy people who's moved into more of a new economy. And during that time, I managed about $40 billion in assets in mostly mid cap and large cap publicly traded US equities.
Poonam?
Hi, everyone. I'm Poonam Mathis. I am currently an independent board member for a SPAC that just launched or just started trading, Fifth Wall Acquisition Corp. 3. Previously, I was a PropTech founder, founded Raise Co-working, which was going to be the first co-working in Manhattan with fully licensed childcare on site, and shut it down as the pandemic got started. Before that, launched another PropTech startup called Stealthforce, which I sold a couple of years back. And prior to that, I was in real estate private equity, overseeing asset management to some extent for Partners Group.
Jim?
Hi, everybody. Jim Fraser. I'm the lending channel manager at Built Technologies. Built Technologies is a SaaS platform that provides a unique set of services in the construction lending space for home builders, for commercial real estate developers, even to consumers who are building and remodeling homes throughout the US and Canada. My background is 30 years in banking, most of that in publicly traded West Coast institutions, managing commercial and residential real estate. I left the banking business for a short period of time and built a construction underwriting and services platform that I ran and then sold to Bank of California and wound myself back into the banking sector. But as the last few innings of my career wound down, I realized that innovation does not occur in the banks. It occurs in fintech and PropTech. So like Gloria, I'm an old economy guy in a new economy place and happy to be here.
And Kurt.
Okay, I don't know whether I fit in the old economy or the new economy. I'm sort of in between, but I'm Kurt Breitenstein. I'm part of the commercial real estate group for New York and New Jersey for Valley National Bank. I've got about 35 years of experience in the banking business, about 32 in credit and lending. And in my role, I oversee construction loan administration for the Northeast, as well as a number of special projects and about a $4 billion legacy portfolio within the Valley organization.
Great, thanks to you all. Just a reminder, I think you're seeing it in the chat, that any questions, please post those to the chat. We'll try to get to those towards the latter part of the segment. So with that, let's start off. And one of the things is really talking about what falls under PropTech. So you heard such diversity in our panelists, and similar to fintech, it's a buzzword, but certainly it covers really around the real estate space, efficiency, going digital, and new consumption patterns. So affects developers, investors, property managers, financing, insurance. It's a really wide spectrum. So with that, let's start off. Kurt, give me your thoughts about, and we'll maybe post this to some of the others too, but what do you think the latest trends in cretech and proptech that really stand out to you?
I mean, broadly speaking, technology is about efficiency. It's about getting things done quicker, fast, quicker, easier, cheaper. I use the catchphrase "simple, fast, and easy." It's all about trying to get to simple, fast, and easy, regardless of the scale you're talking about. In the CRE or in the PropTech space, I think COVID kind of hastened a lot of people's interest in getting to that simple, fast, and easy by virtue of the fact that they're locked in their basements for an extended period of time. Things like cameras, remote inspections, how to manage a building remotely, be it systems, accounting, collecting rents, paying bills. To me, it all boils down to efficiency.
No, that makes a lot of sense. Is any of the other panelists want to weigh in on that question?
So I'll chime in, Bob. I think, one of the things that we've seen and I've seen over my career is what Kurt was describing is inefficiency in what we call offline activity. So think emails and PDFs and Excel tables that, owners, developers, general contractors, lenders all have to interface with. And our business is designed to specifically digitize as much of that as possible, starting from the very commencement of a pre-development concept all the way through completion of a construction property. So we think of it as fixing lending and fixing spending in the construction space, and that's what we're dedicated to do.
Great. I know, so certainly in the news, President Biden's infrastructure bill has about $213 billion in towards building energy efficient, affordable houses and buildings. So how do you think that might spur innovation and investment? What are your thoughts on that, Jim?
Yeah, look, setting aside the political nature of your question, look, I think the U.S. financial system has long been dedicated to a variety of things to kind of help buildings become more efficient, lower energy costs, right? The whole LEEDs movement. You even see that in the whole property clean energy, the property assessed clean energy program. So CPACE is common in many US states. You think of LIHTC, right? Low income tax credit, which has been around for a while to help spur the development of low and moderate income housing. And even if you go into Fannie Mae or Freddie Mac's programs, there's residential mortgage loans to help buyers get fairly, heavily advanced, like 95% loan to value transactions to buy and rehab homes in distressed communities. So all of those things, I think, are kind of the quilt work that's in the financial system to help make the US market, real estate market, more dynamic and more able to meet the needs in the marketplace. So, we see about 4% of the US construction spend comes across our platform. And those products are really kind of a significant portion of what we see.
Switching topics really quickly here, certainly on everybody's mind, the pandemic has been front and center over the past 18 months. So I'll kind of pose this for each of you. How did you see the pandemic really changing the trajectory of some of the trends in the real estate market? Maybe we'll start with Poonam.
I think from where I sit, I focus on PropTech. I don't focus on the traditional built world anymore. And I will say that about 6-7 years ago, when I left traditional investing to launch a PropTech platform, it was like pulling teeth, getting people to have that conversation, getting institutional funds that had the scale to be able to deploy things on that level. To have the conversation was difficult. Once you had the conversation, the numbers made sense, and then everybody understands how it works. I think that what I have been seeing and hearing from all the other entrepreneurs and startups that I speak with during COVID is there has been a little bit of a culling, because the investors in venture capital and what have you have been a little bit more careful in holding on to some of their dry powder in terms of funding these startups. But the startups that are already out there have been having, if they have already proven what they do, they have been able to get in with the builders and the owners of the bricks and the sticks, because ultimately, this is a cycle-based business, and there are good years and lean years. But everyone knows that the goal in real estate is to stay alive and hold on to your portfolio until things get better. And COVID, more than anything, I think for a lot of owners, gave them at least a half of a pause, so they could start to think about efficiency in the system surrounding their built world, as Jim was talking about, right? Enhancing that efficiency is no longer something, I think in COVID times with decreasing occupancy the way it was, I don't think it's something that they could think as a nice to have anymore. I think they realized if anybody else is doing it, they got to get on board and start trying to enhance their own efficiency in building systems. So the inertia started to shift. Hopefully it's the tipping point.
Yeah. Gloria, how about for you?
So my background, I went to hotel school. I worked in hospitality prior to being an institutional investor. So hotels, travel, leisure has always been near and dear to my heart. And this is the third kind of bomb that went off in the industry in a matter of, since you had 9/11, and then you had the 2008 Great Recession, and then you have this. And the industry has been remarkably resilient. So in all these times, every single time, despite occupancy drops of 20-30%, it forced them to cut costs and really just kind of think of a different way. However, this time you had full-on shutdowns of hotels, and I think what it really, as people got very nervous, it's like, oh, I don't want to take an elevator. I don't want to share an elevator with anyone else. It really kind of pushed the pendulum swung towards Airbnbs. I think prior to the pandemic, people, I know people used Airbnb and they would think of it as an alternative, but I'd rather stay at a nice hotel with pool and all that kind of stuff. And then it just became this, no, I want a nice house. I don't want to be near anybody. There are no restaurants open. I've got to cook. And I think that those kinds of platforms, Airbnb is just a, it's the traditional business is just aggregating different kinds of alternative residences, but obviously they have the platform and the bodies and the marketing. And I just, I think that is the way that people are going to go moving forward. I think there's room for hotels, but I think prior to this conversation, we were talking about a bunch of residential properties coming online in New York, and you've got a ton of hotels that opened up in the last few years, and some of them are going to be mothballed and never reopen. So, just what to do with some of the physical real estate versus having, the software that leads you to alternative accommodations.
Jim, how about you?
I was listening to Gloria, and the great financial crisis was tough on everybody, especially if you're in the financial sector. Survived it, and when the early days of the pandemic hit, I found myself thinking, okay, this is going to be the second version of the same thing. And I immediately began to, and here at the company, we began to hook up data sources that could help us begin to identify, which markets and which use types in real estate were getting affected the most. And it turned out that by plumbing into and building data connections, not just with FEMA for conventional natural hazards, but for states and counties that were going through very severe social distancing lockdowns that were affecting projects in process, it was giving us an eyeball, as sort of a window, and our clients a window into what was the difference between the Boston market, the New York market, the Dallas market, the national market. And as things began to sort of clear up in terms of how people would structure activity on a piece of real estate, physical activity, the same social distancing things began to sort of roll back. And that data that we assembled over the course of the year became basically the underpinning of a lot of risk rating for our clients, client banks. And I think, as you think about how the pandemic affected a lot of people, I would tell you from our standpoint, it's the aggregation of different data sources that helps surveil and monitor what's going on in the real world, the built world, was kind of the key takeaway for us.
Kurt, any thoughts there?
I would have to echo Jim's sentiments. I think a lot of the individual market experiences are what's, sort of driving individual or sector sentiment, if that's the right word. What's going on in the multifamily space in Austin, Texas versus what's going on in the multifamily space in New York. There's been an out-migration in the last year or so that's now started to, the tide started to shift back, of course, but the impacts nationwide from that activity are long-lasting and probably irreversible. New York's going to come back, of course. I think we all believe that, but it's changed the face of future development in some of the other markets where people, at the risk of making it sound morbid, they fled that markets that they fled to. You're seeing a lot of activity, particularly in the Southeast and a number of other markets. And the drive to grow in those markets is going to foster not only demand for innovation, but additional innovation. To sort of segue into the concept of cretech and PropTech. As these new buildings are going up, now they're going to have a lot more bells and whistles that, again, I use the word efficiency. It's going to make them more efficient and more attractive, not only to the investor, but also to prospective owners. If it's a for sale project or prospective tenants, whatever the case may be. And back to what Gloria said about hotels, I think there's going to be a lot of hospitality that ends up in mothballs and ends up being repurposed. At what cost remains to be seen. It's certainly going to be a pricey endeavor no matter what happens, but technology is the opportunity to mitigate some of that hurt, if you will, It might make it more attractive as an investment for somebody. So, there's a lot of moving pieces here.
So let's talk a little bit more about the future of where cretech and PropTech are going, both from a focus and an investment perspective. I know certainly there's some key trends in there. Maybe Poonam, maybe talk a little bit about some of those key trends in the future. Space as a service might be one of those that continues. Certainly has been important lately, but maybe talk about what you're seeing as the future comes.
Yeah, I mean, I think the last space that my startup was involved in was flex space and co-working. I think we all know what happened when things were shut down. There were a number of startups that were getting ready to break through, which were very amenities heavy. And I think the focus at the time was on providing amenities within co-working that made that enhanced the stickiness of the product, right? So that people would be a little bit more loyal to one brand versus another, not just for the social aspect, but for some aspects that they actually wanted, like a doggy daycare, for example, on site, right? Or a spa attached, something like that. And that seemed to be something that was really measurably starting to enhance the stickiness of product. I think that what people are discussing is happening now on a forward-looking basis is that while the world was frustrated at first and then got very comfortable working from home, people do want to get out of their houses. And so co-working is here, it's not going anywhere, it's going to continue. But what is likely to shift is the footprint and the flexibility, meaning not across all markets, but if people have gotten accustomed to working from home in their house up in the Hudson Valley, then even if they only have to work 3 days a week, they may want that Monday, Wednesday, Friday flexibility within a co-working space, but they may want a slightly larger footprint instead of the other amenities, because if people are not in urban environments that are dense, making the most of every single day and working, 80 hours a day, and then trying to get home in time to make dinner for the kids, if things are not so dense anymore, then the need for those additional amenities is not quite as acute, but the need for an equivalent level of calm and space and breathability seems to become more important if you want to charge a valuable price point.
Gloria, what are your thoughts on the future?
I was thinking about my old company, JP Morgan, our corporate headquarters, 270. They tried and they tried and they tried to do everything to make that building better. It got LEED Platinum certified. There was a full renovation, but ultimately the building was built in the 60s. It was the original manufactured Hanover building. And it was designed for a time, like the Wall Street movie, when you have these giant corner offices and no internal offices, and the kind of the reality had moved the other way. I think the WeWork kind of model was it like, I want to say 70 square feet per person or something like that. So it had, the density had just kind of gone from like here down to here. And I think we're going to have to go back to here with a kind of a, alternative rotating schedule, because, the 3-hour commute when you bought the house up in the Hudson Valley is just not going to happen every day. And I think that could kind of alleviate the, the space needs. I ultimately think companies will probably have a similar amount of space, all things being equal on bodies, because people are going to be shifting. But, back to JP Morgan, I mean, they tried and they tried. And I think that the biggest issue with jamming in so many people into the building, they could never fix the elevators or the bathrooms. I mean, there were 2 sets of bathrooms per floor. So I kind of lived and breathed it and saw how bad it could be after a whole day when you have a lot of women and a lot of men with 2 sets of bathrooms on one floor. I'm not going to kind of highlight anymore, and the elevator situation too. When we had VIPs going to the 50th floor, they had to block a whole elevator because otherwise, if you had a CEO coming into the building, you could be waiting 15 minutes given the density of the elevators. So that was just a problem that they couldn't fix. And when the zoning changed in Midtown, they were like, okay, we're just going to knock the whole building down. And you know, would have, should have, could have. I mean, the company had an opportunity to go to Hudson Yards, but I think that the tax credits weren't considered attractive enough. And this is just kind of all history. But I think, you know, ultimately, I think they're going to have to change the building plan again. You know, I'm not privy to it, but just thinking about it as an example, you know, they have the ability to change and pause given the fact that they put a wrecking ball to it. But, you know, I'm just curious, some of my fellow panelists who are commercial real estate experts, what they think, you know, that as a live example, what would ultimately happen.
Kurt, what do you think about that?
I mean, I cut my teeth at 270 Park, and I have fond memories of the elevators and the bathrooms, so I know what she's talking about. But I still have a hard time believing that that was a cost-effective process to knock down a building like that and put up a new one is an incredibly expensive endeavor. But again, technology having advanced to the point that it is or will be in the very near future, you know, somebody was forward thinking enough to realize that there's only so much you can do with a Model A Ford. You can't turn it into a Ferrari. You need to start over. So, you know, to a great extent, I think that may be the beginning of a trend in Midtown. As Gloria says, with the change in the zoning laws, there's more opportunity. In this particular case, it's an owner-occupied building for all intents and purposes. If you were doing this to build another multi-tenant office building, I don't know that the economics would work out so well. But along the same lines, you're gonna build it to today's standards or build it for the future, or at least the future that you perceive. And if that works for you, then you've got to do it.
So, Jim and Poonam, you both started startups in this space. So maybe talk a little bit, Jim, about what was your journey around deciding to get into this. You know, certainly the big buzz has been fintech for a long time, and you know, probably PropTech and cretech is somewhat new to the venture. But why don't you talk a little bit about what prompted you guys to start Built? And
so I'll have to give credit to the founders who were developers here in the Midwest and Southeast, and you know, as the story goes, right, they were trying to receive money from their construction loan from their various banks and found it to be just a cumbersome, paper heavy process. And is like, well, wait a minute, we have these great tools called cell phones that allow us to do so many things. How come I can pay my bills online, I can get my accounts online, but I have this very powerful construction loan and I can't get access to it except through snail mail, right? And all sorts of different solutions. So that was a sort of a pain point that ignited the business. And the business grew into kind of two constraints in the financial system. One is banks and non-banks really have limited risk appetite. When you think about construction loans, when there's a loss and when the market deteriorates like it did in 08 and 10, the loss severities in construction assets typically are the highest. So there's a constraint just in the amount of money and capital available to invest in those asset classes. And because of that, the other side of the coin is no one really will invest a lot of money in CapEx, in loan origination, or in servicing systems, or in administration systems. And so the poor stepchild that has high risk gets no food. And Built sort of fell into this opportunity as we grew to get more and more of that volume passing through our systems. And all of a sudden, we now have a lot of it, and we've used that opportunity to sort of slide into between all sorts of different systems a simple network that stitches together owners, contractors, lenders, and third parties like title companies and inspectors, so that the process is more smooth more easy to Kurt, right? Smooth, easy, quick and easy. That's where the business is today. And it's getting the momentum started. It took us a few years, but now it's rolling.
Poonam, your thoughts about some of the startups that you've done?
Yeah, I mean, I'll chime in here. I think like most entrepreneurs, it starts with aggravation and then aggravation turns into fixation, right? There's probably a more elegant way to say it, but essentially. So I was working in real estate private equity. I was overseeing a global asset management team. And, we were doing deals like all the big guys in every asset class and in every part of the globe. We had a deal in Wuhan, which I toured and all that kind of, right? We had deals in Fairfield, Ohio, whatever it was, which meant, companies of that scale necessarily hire generalists, right? Generalists who are willing to figure it out as they go. And at those deal sizes, things can be a rounding error, right? But the traditional real estate person in me, I had grown up in a real estate family. I had done development, real bricks and sticks stuff, hiring and firing general contractors, et cetera. The traditional real estate person in me was always a little bit frustrated at not being able to get asset specific information on that part of Australia for that type of industrial deal. And reading the reports that JLL provided on that submarket didn't make me feel like I had any kind of an edge from an asset management or risk perspective or sensitivity analysis perspective. And at the meantime, I was reading all about the gig economy going up market and upskill essentially, and it hadn't existed for real estate. So that was the genesis of the idea for my first startup, Stealth Force. I decided to launch the gig economy of commercial real estate investment talent and launched that, and it was well received. And then, as you do as an entrepreneur, followed the demand. We built essentially a software-based matching platform that could give us the ability to scale up, and quickly found out that companies out there that had their own flex talent forces and somewhat repetitive projects were very, very interested in that as a SaaS product over and above or even separate from using our talent on demand. So we sold the business when that sort of made sense. And my second startup, Raise Co-working, was again a personal pain point. I had a son who was at that point 3 years old. I had a nanny who I had to let go of. I had a need for more flexible workspace, and I wanted licensed caregiving on a flexible basis, hopefully within 100 feet of my office. And it didn't exist in New York City. It turned out to be a real estate problem that needed to be solved. It turned out that it was about lease structuring, and it was about getting the right childcare partner and handling all of the Department of Health licensure. So it became another Rubik's Cube to figure out, which we were close to figuring out. And then, necessity is the mother of invention and extinction. So COVID extinguished that one.
So let's pivot a little. I know a big topic of interest is SPACs these days, and we certainly have a few of you that are very familiar with those. So maybe, Gloria, can you give us a little bit of an overview of what is it? I know it's been around a while, but maybe for those who don't understand it, and then why such the flurry now, and where do you think that's going?
Well, SPAC means Special Purpose Acquisition Corporation. So it's effectively a blank check company. And they have been around for a while, and there are various versions of it. The kind of old version of SPACs, you had a kind of private equity guy, they went, or girl or lady, and they went out and found a target that was broken, and then they would fix it up, and then and the private equity expertise combined with the kind of broken company, you could get it at a good value, and then the original investors would buy in. Everything's based on $10 a share. I'm not really sure why, but it is $10. It's very easy. So you buy in at $10, and typically SPAC investments, you get the sponsors get 2 years to find a deal. So it's kind of a way to invest in private equity, and within 2 years, they come back to you with a deal, and the shareholders either say, yes, I'm really interested in it, or no, I'm not. And if you're on the no, I'm not, you get back your $10. So in a low interest rate environment, I'm like, my only opportunity cost is actually, what if the market goes like this? Then, I could literally have a little egg on my face if I put a lot of money into this. But at the same time, if I were just putting money in the bank, I'm kind of losing money anyway. So if I'm going to get my $10 back, I mean, that's a very simplistic thought. And then you get a bit of a warrant, the highest, the kind of very marquee, the Gores, some of the really marquee SPACs are doing, a quarter of a warrant today. And that's just kind of a little bit of an equity kicker to say, we were the original investors and we get to look at this deal, and hopefully it's going to go much higher than $10. So in the PropTech space, that's a relatively new SPAC kind of sector. And in the last few years, the old model of the SPAC where you bought a broken company has totally upsized. It's just gone upside down. Today, the SPAC is more of a small cap IPO alternative. And I think that, for one, there's not a lot of bandwidth for small cap IPOs. And I think there is a statistic that we are like, compared to the 70s, 80s, 90s, we're like, there are fewer and fewer public companies. And obviously you've got your $1 trillion companies like Apple and I think Amazon's there and a few others, but in Microsoft. And then, just the interest in small cap is not there, and the interest in the IPO process is not necessarily there. And the other piece is that this is a little bit of a replacement for later round VC funding, which can be quite expensive. And this also allows the target to effectively have a lot of control, because the usual math is 20% from the SPAC sponsors and 80%. So why would anyone want to buy a SPAC? It's kind of a free look for 2 years and maybe a potential upside. You get in at $10 and hopefully the stock is a lot higher. Right now, it's been a little bit dicey for the SPAC market, but I think we have about 11 that have gone public thus far. My sister company is Porch, and that's been, I think it's up like 80%. So that's great for us. And they are a PropTech company that is a little bit like Jim's company, that except it's more residential and just kind of helping a buyer with the process and checklist of, I'm going to move in 6 weeks from now. I need, title insurance, different, home warranty, who are going to be my movers, who's going to help me out with just like, Angie's List type products. And, there's a huge, it's very fragmented and there's a huge opportunity. And Porch went public with PTIC 1 because, ultimately it gave them a lot of cash on the balance sheet. They were able to maintain control and kind of go public in a way when their revenues were pretty nascent. And I think the other piece about an IPO is that historically you have to be kind of close to profitability or have meaningful revenues. And if you're on a trajectory like this, it's hard to really tell the story of going public, other than biotech, which has seemed to be given permission to go public in phase 1. Other than that, most other companies don't have that permission. So Poonam, I think you're a new SPAC independent board member too. So maybe you have more to add than my long diatribe just now.
No, I mean, I think that was fantastic, because a lot of people are talking about SPACs that really don't know any of the history. The only one thing I would add is to say that I think we're saying the vehicle has been around for a long time. It has been around for about 30 years. And what people don't realize is that it was there for a reason. It's just been rediscovered. It's giving the opportunity to some of the smaller companies to tap into the public markets, which they really should have had. But valuations became inflated and expectations of valuations became inflated to such an extent that some really solid companies with fantastic operating teams and real long-term solid growth potential sort of started to think of going public as not even an option to them. And I think when you look at the SPAC space, the resurgence in it, it shouldn't necessarily be steeped in your brain as being a fad. It is a revisiting of something that was there for a reason.
Do any of you think that the SPAC concept will have a disproportionate effect on the PropTech, cretech space, or do you think it's independent of industry?
I don't know if I'm equipped to speak to that. That's a good question.
My 2 cents on it is because PropTech is so nascent, and some of these companies have, I don't want to say proof of concept because I think that's a little bit unfair, but if you only have a year of revenue and maybe you were founded 2 or 3 years ago, it's really hard as a public company investor to say, we can tell a story to IPO. And the other piece of it is that some of the CEOs, if they're a real kind of founder mentality, there's a whole, process of going public that investors want to see. And as an example with Porch, just hearing the backstory, our SPAC sponsors said, well, there was a new CFO and we thought about not having the CFO on the roadshow. And I said, no way, you would have gotten annihilated for that. And they ultimately decided to have him on there, but it was, he was new to the company and they were upgrading talent. So, that's, I think the amount of price certainty to the company is very positive, the target, but, I think PropTech lends it to itself. And then obviously there's been a huge EV thing because again, nascent companies without a lot of revenue. In the SPAC, whatever, 3.0 version.
Jim, has SPAC come up in your company conversations yet?
No, it hasn't, but I was thinking about my 15 years in public company executive positions and dealing with the quarterly earnings regime and the analyst questions at quarter end and the difference between those days inside of the banks I worked at and a VC funded fintech platform that serves the banking sector, right? And we've been at it for 7 years. We have a lot of foothold both in the US and Canadian banking sectors and non-bank sectors. And I think our runway is a long one. We look at the US construction spend at about $1.3 trillion, and something like 800 billion of that is either residential or commercial construction. And we've just begun to really kind of grab that share. But clearly we've sort of hit escape velocity. We have a blue ocean in front of us and not much competition. So for us, I think it's going to be stick to our knitting and run the game out as far and as long as we can, and build the business the kind of old-fashioned way would be my thinking.
Sounds good. Hey, I'm gonna go ahead.
I was gonna say, but Gloria may be calling and saying, Jim, it's BS. We're gonna knock on your door tomorrow.
You're way old school.
Yeah, don't you want to get back into the game of meeting with investors? And
well, I'll take investors over regulators any day.
Well, that is an issue with the SPACs, is that I think that there's a little bit of regulator envy, or there's some reclassification of the warrants, which is not great, because I think several years ago the SEC, no, warrants are equity. I mean, it's like an option. I always thought a warrant was like a kind of a fancy version of an option. I'm not an accountant, but that's the way I thought of it from my CFA courses. But now it's become, no, a warrant's a liability. And so I think that there needs to be some cleanup. And I think that probably ultimately there will be a more equal playing field. And right now that the traditional SPAC investor, there's a lot of retail people on top of institutional. And I think that the dissemination of information needs to be a bit more equal footing for all kinds of companies. Like, you know, I still think that as an institutional investor, you have so much more access, even though it's, you know, there's Reg FD and all this stuff, but still at the end of the day, like as a, you know, I have my E-Trade account or my Schwab account. How are you going to actually figure out how to invest in companies? It's just pretty unfair.
I know we've got some more questions that we could go through, but I want to dip into the chat real quickly here. There's a question in there, and I'll kind of pose it to all of you. How could technology and digital product offerings be leveraged for more than efficiency? What ways do you think PropTech could enable add-on transactions or new sales to customers? And says customers used loosely, so you know, whoever your customer might be, as a way to grow revenue. So let you guys think a little bit about that. Kurt, any thoughts on that front? You could start us off.
I immediately think of our own business, Bob. You know, the faster that I can, I would use the word analyze, but size a transaction and come up with a decision whether we want to move forward and make an offer, issue a term sheet, you know, further negotiations or discussions. The faster I can do that, the faster I can get a deal off the street and into my pipeline. Technology, PropTech in particular, because we're in the commercial real estate world. And this goes not only for PropTech. I think it's almost universal in banking. If I can get the information faster and in a more concise, you know, an accurate form. A lot of times you get people faxing you copies of hard documents and, you know, doing it the old school way. Sorry, Jim, didn't mean to put it that way. It'll just very much like Built Technologies wants to get rid of all the paper and all the slowness in the process and create a platform where all this data can be uploaded and it can be synthesized and processed and analyzed with decisions behind it in a much faster fashion. So for me, if I get something from a client and it's completely electronic that I can work with, I can spin it and move it on to the next step a lot faster. You know, and again, back to Built Technologies. Their platform alone enables a bank that utilizes it to get the money, you know, potentially evaluate a construction advance request, get an inspection done, loaded in the system, title work done, and an advance out, say 5 to 7 days faster. That's 5 to 7 days of additional accrued interest. So it's a money-making proposition for an institution like ours to move that much faster.
Thanks, Bob. No, I was going to say that it's, yes, the banks are clients and customers, but what's most important to us and to our customers is it's our customer's customer, right? And those repeating opportunities, whether it's a developer, a sponsor owner, or their general contractors that they're doing business with, or if they're a GC themselves, and the pattern and practice and the efficiency that entire ecosystem experiences, including the extra days of interest that you described, Kurt. Obviously, that's additional revenue on the earnings side of the bank, but it's also the downstream effects and the payment sequencing to the general, to the sub, to the suppliers. And that ecosystem is also an archaic old paper process. And we're in the middle of engineering most of the solutions for that payment stream. Once that all happens, you become a much preferred client bank than your competitor.
Exactly. And your product is really, it's not construction loan management software. It's you're supercharging the velocity of money. Let's put it in pure economics terms. You are accelerating the velocity of money.
I can chime in here a little bit as well. I think when people think about PropTech, sometimes they're really focused just on the software solutions, and that gets a lot of airtime for a good reason. But another way to think about it is, because as we've said, PropTech is so broad, there are things like autonomous vehicle offerings that are specifically designed for office use. So for example, think about having an office park somewhere with a limited amount of parking. You can't change the zoning and you can't get more parking spots, and there's only a certain number of bodies you can get into the building. You can expand your universe of potential tenants by using one of those autonomous vehicle companies that will then shuttle employees who work in the building to an offsite parking lot where they can also have their cars, that kind of thing. So you kind of enhance the usability of a building. Another one that comes to mind, which I'm just trying to make the connection between the actual technology and the increase in usability of the built world. So another one that comes to mind is there are a number of companies that are providing renters insurance for lessees that potential tenants that may not have as long of a track record. Their company hasn't been around as long. Meanwhile, we know a lot of landlords are sitting around with this space and they'd be happy to rent it to someone. But if that company hasn't been around long enough, it doesn't have the working capital, they may not be able to even post the letter of credit. If they can get approved through the algorithms that are being run by these new companies, then the company takes on the lease risk, and the tenant pays, the lessee pays the startup a certain fee every month, but everyone is covered, and the actual usability of that space and the direct dollars going into a landlord's pocket for space that would otherwise sit empty has gone up.
I was actually thinking about a kind of newish REIT sector that really gained popularity 6 or 7 years ago, but never really came to fruition, was the single family home rentals. And so when I was an investor, we bought into the American Homes for Rent IPO, and the promised land of it was that the founders were the public storage, and if they could do storage like they could do single family home rental, it was going to be a win-win-win. And I think that ultimately the prices of homes went up pretty quickly. So these kind of fire sales for homes, that that part of the cheap housing stock wasn't necessarily as great, and everybody was in a kind of a wild west trying to buy the houses. So that was one piece. But then the next piece was actually the efficiency of running homes. So you had long established multifamily apartment REITs that were great because you've got one building, you've got one person fixing things, painting, whatever. But what do you do when you have a bunch of homes that are in disparate locations? And I think there's a lot of technology that could help, because I think in the beginning, even American Homes for Rent, like they said, well, what we found were some of our maintenance workers, they were like kind of going to one place and then, maybe taking a coffee break, smoke break, going to Chick-fil-A, whatever. We finally had to put trackers on their cars just to see where they were going. They were like low jacking them or something. But I'm sure that there's much more kind of customized software that would help the efficiency, and also, figure out logistically, like, why are you going from here to there? Like, you should be going from point A to point B to point C, just simplistically, because I think, ultimately the model should be here to stay. We're in this great suburban migration. And I think in the last housing peak in the kind of mid 2000s, the home ownership rate was in the high 60s, and there were probably 5-6% of the population that should have never had the ability to own a home. But it doesn't mean that they can't rent a home. So I think, and the desire for space, and I think as we had early on talked about, like a New York versus an Austin. New York's going to take a while.
So Gloria, I'm going to pivot off what you said, because we inspect nationally, I think about 30,000 properties a month, and those inspections are progress inspections, right? Is the framing done? Is the plumbing in place? Is the progress being made relative to the construction draw? And we approach that almost like an Uber model, where we're trying to aggregate and sync up in geography the properties that have to be visited by an individual. So we're not tracking them by LoJack, but we're tracking them for their own benefit, for their own consistency of delivery of service. So back to delivering information to Kurt so he can make a decision to disperse dollars, we can do that quickly and effectively. So there is some crossover in things that you would never think, like Uber to property inspections. But that's a little tidbit that made me think about it when you said America's Home for Rent.
Here's a quick one, like call it a lightning round question. Where do you see the greatest investor interest at present? Commercial or residential real estate, tech, and why? So maybe a quick one there. Jim?
I'd say payments.
Payments. Just across both.
Literally does. It's not a use question.
Yeah.
It's what Kurt and I were talking about. It's like, how fast can money be moved in the construction space? And that is by far the highest interest we see.
Gloria, what do you see?
I'd say I agree on the payment side, but I also think just, residential, I just don't see it really cracking. I know that there are some kind of headwinds with labor and even lumber prices and all this stuff that, we were in such a housing, it was just such a drought for so many years, and we've had population growth. And, I think there's this lady who's this, housing guru, Ivy Zellman. She used to go on, oh yeah, the millennials, they want to live in apartments forever. They don't want to drive ever. They're going to Uber everywhere. I'm like, no, life has been delayed. You have crushing student debt. You're delaying having children. But by the time that you are having your first kids, and maybe it's, more like late 20s, early 30s now, not early 20s, you're going to need the same things that every other prior generation needed, which is a car, Costco, and a house. So I just, and especially where the borrowing rates are right now, I just see it continuing. And then the work from home, like at least part-time model, just kind of expands the geography of where people can actually live. So they don't have to live in the, $1,000 plus a foot apartments in New York. I mean, you could drive 2 hours away and you're probably in the couple $100s a foot.
Poonam, any thoughts?
Yeah, I've just been nodding as Gloria was talking. That this idea of millennials being sort of genetically different than the rest of us was wrong. And again, when the babies come, everything changes. And I second everything she says.
Hey, so maybe one last one here. I know we have to cut over to the networking session in a couple minutes, but this question says it's about some specific cretechs. Wondering what panelists' view is about companies like Point or Picasso, where real estate ownership shared by a small pool of investors. How do they view viability and investment potential of this type of idea? Anyone want to jump on that one?
Not familiar with that.
Yeah, neither am I, but it sounds like it's a more question of crowdfunding than anything else.
SPVs type things.
Yeah.
I think some of them have worked for special purposes. Like, I think Marriott used to do these like EB-5 programs, like, you bought your share and you got your green card. But or tax credit driven, but I think just crowdfunding for real estate has always been some kind of other alternative reason, not because there are just too many fees on margins that aren't that high.
I would agree with Gloria. In concept, it's a wonderful idea. You go online, you fill out your information, give them your credit card number, and suddenly you own, 1/10,000th of a percent of a building in Manhattan. But nobody thinks that there are, situations where you might be subject to a capital call, or you could be subject to losing your investment, however small it may be. There are a huge number of pitfalls in crowdfunding. Although it's been done successfully, I don't think we've seen the bottom of that barrel yet.
There was one, Jim, one question here about could you talk to platforms, marketplaces, or embedded products? And it kind of strikes me that Built is somewhat of a platform, but I don't know if you want to.
Yeah, so we're partly a platform, right? An enterprise solution for financial institutions, but there's a marketplace component to the diligence activity that surrounds it. So, like I talked about inspectors, right? We have a marketplace of national inspectors. We have a marketplace of title vendors that support lien monitoring and other kinds of controls around risk in the book. But at the end of the day, what I would say is, when you couple the platform and the marketplace services that we offer, what it really does is it drives expansion of opportunities for our clients. So, one client may not have an ability to do a certain kind of product, C&I lending or home builder borrowing bases. And by getting their access to the systems and the solutions, all of a sudden that opens up new business to a client. And we found that to be an extremely beneficial solution for our customers.
Excellent. Well, with that, I think we are at time, and we're going to head over to networking. So I want to thank all of our panelists. I thought it was a really good, really great discussion. And I guess if people have more questions, they'll catch us in the networking sessions. But thanks again, and I'll turn it over to Jen. Jen, you're on mute.
Had to be the person. I had to be the one.
Somebody had to do it.
I nominated myself. No, thank you so much, Bob, and everyone. Really, probably we could do 5 more sessions on this topic. Could have gone down so many other pathways. So this is terrific. I think everyone learned a lot. I think Bill from NYPAY is going to set us up in smaller groups for anyone that wants to continue the conversation and ask additional questions. And again, thank you for everyone for joining. And I really appreciate all the support from Valley Bank and NYPAY, and looking forward to the next session. So I will join you in the breakout room. So break us out.